Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is our good friend Thomas Parilla, president of Parilla Investment Group. How are you doing today, sir?
Good. Happy New Year, Ivan.
Yeah, Happy New Year to you and everyone watching. I wanted to get you back on to talk about what do you think Powell's going to do next and how will it affect the markets? Everyone's watching gold and silver very closely these days. What do you think's coming up next, Thomas?
From the looks of it, the Fed's telling us they're going to cut three times in 2024, but the street is telling us it's going to be more like seven. And there's about an 85% chance we'll get the first cut in March. So I think once they start to cut, I think then you're going to start to see the economic data get worse and worse as the year goes on, and that's going to spur them to cut faster. So it should be the opposite of what we've lived through the last 2 years. We should now start to see one rate cut after another.
And when these rate cuts come, a lot of people are saying that gold has the potential to just break out and silver will hit all new all-time highs. And then there's other people on the other spectrum saying once they do decrease the rate hikes and go lower, actually gold and silver are going to go down first and then go up. What's your take on it?
The first couple of rate cuts always have the most effect. So that'll be the most dramatic. So I would suspect the first two, three cuts, you're going to see pretty dramatic moves up in gold and silver and down in the US dollar.
Oh, okay.
After that, I think they become a little bit more muted over time, but it all based on economic news. So if the economic data continues to be bad and starts to deteriorate, then they'll start to price in the additional cuts.
Right.
We just had the dollar drop from, the dollar index went from 106 to 100 just in the last 2 months.
Well, that's crazy.
Yeah, almost a 6% drop. Now you start pricing these other rate cuts that are coming. I'm very convinced we'll see the dollar index drop to 90 fairly soon. And then after that, slowly make its way down to 70. But you can see how dramatic of an effect it had, though. I mean, just going from 106 to 100 during that same period, I keep an eye on some of the leveraged gold funds like Nugget, NUGT.
Okay.
That went up about 50% during the same time period.
During the same time period, 2 months as the US dollar decreases.
Yep. As
So
the
you're
dollar
so
went from 106 to 100, Nugget went up 50%.
So as basically what you're trying to say is in the future, maybe in 2024, as they decrease the interest rates at the Federal Reserve, you're going to see a lot of the mining side. Like what's the potential gain on the mining side as gold continues to rocket higher and the US dollar continues to decrease?
It should just be huge. I think we're heading into one of the best years in the mining sector, maybe in my entire lifetime. We're going to see interest rates go down. And at the same time, you're in a situation right now where there's huge amounts of supply, of demand, but supply is getting tighter and tighter.
You
And
mean
that's
on the mining side?
on the mining side. Yeah. And even on the dealer side. I mean, the dealers that I talk to, I think they've got enough gold and silver in inventory for one small bull market. So if gold moves from 21 to 2,300, I think they're cleaned out.
Right.
Uh,
And then where are they going to order more, right? They got to.
right. And then premiums are going to go high. I mean, all of a sudden you're going to see 30, 35% premiums. The gold to silver ratio right now, I think the last time we spoke, it was around 80. Now it's about 85. And we're getting to the point now where silver is getting very drastic.
Undervalued.
I can remember at one point seeing it go down where the ratio was 90. And that was at the point back when silver went down to as low as like 13 and then turned like a rocket and went to 29. And
Historically, in the past 100 years, sorry to cut you off, what is the gold and silver ratio historically on average?
the hard part about looking at historical averages on it, I think we're entering like a different paradigm now because
Right.
we've never been able to compare the gold and silver ratio to a point
Yeah,
where we
yeah.
have US debt. So looking at past history, it's going to be harder and harder. You can look at it and say to yourself, should it be at par? No, that doesn't make any sense. But I mean, should it be at 100? I think you're going to see now a whole different economic plate put in front of us that people are going to have to now start to reevaluate. If you look at Mexico right now, we get a lot of silver out of Mexico.
Hmm.
Production dropped quite a bit last year there. And I think what will happen is if you get silver up to say 30, 35, then you'll see a spur where you'll see a new round of production come in because exploration it'll be worth it. Some mines that maybe aren't economically feasible when it's at 25 will be when it's at 35.
Hmm.
So, that old saying, what's the cure for low prices? Low prices, because that'll spur on more activity.
Yeah.
But yeah, right now, if you look at silver, the all-time high we hit in 2011 was $49.51.
Okay.
Now, last year, global silver demand increased by 10%, but global mined silver decreased by 2%. That's a pretty drastic difference right there, 12% offset. And
And the
that's,
whole green revolution coming soon, and they're pushing towards probably they're going to need more silver as they go green. So for sure, demand I'm thinking will increase. It's
that has
inevitable.
to. It just
Yeah.
has to. I mean, between solar panels and electric vehicles, I mean, electric vehicles, silver, copper, cobalt, lithium, you're going to need all of it.
Right.
And we don't have anywhere near the capacity right now to roll out electric vehicles. But in order to do it nationwide, you're going to have a huge amount of mining coming in that area. The car companies are basically going to turn themselves into mining companies. It's the
Because
only
they
way
need the
to happen.
raw metals to get those green energies out,
Right.
right? Right.
And that's where they're probably making a real mistake. Detroit, I think the Chinese are going to eat our lunch because right now they've got the minerals to roll out the electric vehicles.
Right.
And you can see the United States, pulled back to the point where you only get 23, 25% of the market because that's all the minerals we have to support it.
Yeah, I think China has like 70% or 80% of the world's rare earth minerals.
And that means they can dictate to you what
Yeah.
comes next. I mean, really, from a strategic point of view, you'd have to say rolling these electric vehicles out is probably a terrible economic idea for the United States. Whether it's good for the planet or not, that'd be a different discussion, but it's probably economically going to be terrible for the United States, I think. But from the mining sector point of view, you're going to have a lot of money flow into it, and they're going to have to really make a real strategic push to bring strategic minerals, rare earths, and just your normal precious metals online.
Hmm.
But yeah, I mean, I'm looking at what's happening right now economically. I tell you, we're really in a pickle. I think the Fed right now would prefer not to cut rates, but they got the banking system in such a mess where it's hanging on by a thread that they almost have to cut rates in order to save it. And they walked the 10-year, the 10-year note that got up over 5%. Right now, it's down to like 3.85. I think they had to bring it back down because the treasuries in those banks were so underwater. You were talking about billions. I mean, they're saying that even on the commercial real estate side, the devastation there, the banks are going to take like $160 billion hit.
Wow.
But I hear it could be maybe as high as like 5 to 600 billion. I mean, there's some really choice places inside our big cities that are going at like 50% discounts. Somebody's going to eat that, and it's going to be the banks.
So I just wanted to let everyone know about our new sponsor, Strategic Wealth Preservation. They are an international precious metals dealer and they are a secured storage provider that have headquarters in the Cayman Islands. The company owns and operates a large Class 3 UL rated vault in the Grand Caymans, and they offer other strategic locations as part of its global storage network. They specialize in the acquisition, secure storage, and liquidation of precious metals for individuals, companies, trusts, and wealth management professionals on behalf of their clients. So if you guys want to check them out, the link is in the description below. And I heard a lot of these banks have unrealized losses that they don't actually declare on the books right at this very moment, but they are lost, whether it's in the stock market or due to losses. They just declare them as unrealized losses, and they're in the hundreds of billions.
Right. And and a lot of that is treasuries.
Well,
That
their treasuries? Why
a
is
lot,
that?
well, they're sitting way underwater. They bought the treasuries and they leveraged them and they bought more. And then interest rates went up, prices of treasuries dropped. So all of a sudden they're sitting there, looking at on their books. If you mark to market, maybe they're trading at 80 instead of 100. 20% loss on paper. I saw callable CDs back when this is way back when Clinton was in office. We had a period of time when Bill Clinton was in, and we went through a whole series of rate hikes. And
Hmm.
all of a sudden, these callable CDs that trade like a treasury, they were 20-year notes, they were trading at 70, 75. Now, if a person held it all the way to maturity, who cares? You're going to get par. But if somebody walked in and said, "Hey, I need to sell that," all of a sudden their 100,000 was worth 70,000.
Oh, that's brutal.
Yeah. And the thing is, none of the banks mark to market. So if a person got their account statement, they'd look at it, they say, "Okay, I put 100,000 in, it's worth 100,000 today." Now they're starting to change the rules where you have to mark to market, show a person where it is.
Oh, so they wouldn't actually show the person where he was at?
No,
Oh,
no.
that's brutal.
Yep. They went through that whole thing. And I can remember back then, I think it came through actually the state of Pennsylvania came through with a ruling back in those days where the banks had to mark to market on
Wow.
callable CDs. But I think in a situation like that, you've got the same scenario playing out only in US treasuries and the banks are holding them. So the government's working more with them because they have to. Otherwise, they know they'll lose the banks. And that's what happened with Silicon Valley. When it went down, people figured out they were upside down on their treasuries. And then all of a sudden, the rumors started that they were short on cash.
Right.
And what people found out is the cash really isn't there. And that's true of all of our banks. The only thing holds our banks together is confidence. If you're confident that the United States government will back them up, and that it's a safe institution, well, then, the bank's fine. But if everybody lined up tomorrow morning and said, hey, I want my money out, that's it. The bank doesn't have it.
So all it takes basically is another like maybe if it could be a string of banks that the government can't bail out, but they would eventually bail out because they don't want people to lose faith in the dollar, right? If it,
You can
inevitably.
say that the bank's been bailing them out all along right now because
Right.
they're doing that overnight repo situation
Yeah,
where they're
yes.
backing the treasury, and all that's doing is that's allowing the banks to have liquidity so they don't have to sell those treasuries and they can just hold them.
Because if they sold them, then it would be everyone would be running to the gates.
Right, because then it turns from an unrealized loss into a realized loss, and they got
Oh,
to put it on their
gee.
books. And then
Oh, geez.
they have their quarterlies, and then when that hits the fan, everybody says, "Okay, what's going on here?"
Do they
So
eventually have to sell those treasuries or no? Can they keep doing the repo market and playing with that?
well, they claim that it's supposed to run out in March, that program, but I don't see how it can. I think the government will have to continue it until rates come back down. If rates come back down, of course, then treasury prices will go back up and that problem will go away on its own. And I think that's what they're trying to do. They're trying to buy themselves enough time. And some of those treasuries you figure will reach maturity. And when they do, they'll come back to par. And that's the thing about the way a bond trades. If you bought a 10-year bond, it'll have a lot of volatility in the actual price initially. So if you put 100,000 in and interest rates went the wrong way, maybe a year later it's worth 70. So
Right.
70,000. But what will happen is the volatility will get smaller and smaller as you get closer to the end when it goes back to par.
Like the
So
10-year?
yeah, all of them, 10-year, 30-year, all of them. It'll look
Right.
like a wedge, go like this. So
Right.
the volatility is at the beginning, and then it gets smaller and smaller until you get here, and then it'll
So
go back to 100.
so these banks are waiting till the volatility is nothing till they break par so that they can sell their treasuries and then not use the repo market and declare it as an unrealized loss.
Right. Yeah.
That is nuts.
And the government's backing it up so they can do that.
So basically we've been bailing out the banks this whole time.
Yes. Yeah. It's a stealth bank bailout. It's been going on the whole time. People were watching the repo market and trying to figure out, okay, what is going on here? Why are these numbers so haywire? And that's what was going on. They're
Wow.
they're backing them completely, and they're not calling it a bank bailout because they've done all their studies where that's a red hot word to use. So they're staying away from it. But make no mistake about it, they've been bailing the banks out ever since Silicon Valley went down. And my
Wow.
guess is they would have lost at least 3 or 4 banks during that period, and all the regionals would have been in trouble. Zion,
If they didn't do the reverse repo and let them do what they're doing right now.
absolutely. Yep. Yep.
Wow.
You can run through the whole group: Zion's, Key Bank, First National Bank, Bank of Guam, Bank of Hawaii, and there's a whole list of them. And every single one of them would have been in deep trouble without the government backing them up.
Wow, that's insane. That's that's incredible. Well, Thomas, I want to thank you so much for coming down to Wall Street Silver and talking with us. It's always a huge pleasure having you on. Where can people contact you, connect with you, and follow you?
Yeah, the easiest places to find me out on LinkedIn. And 2024, I think we're heading for a lot of fun.
Yeah,
My main theme for 2024 is going to be pause, print, pivot, pause, pivot, print, and then profits in the mining sector.
right.
I think we're going to see those 4 things play out together. But the first thing is what we're in now, the pause. And anybody who wants to reach out to me, I'm more than glad to talk anytime on LinkedIn. Just reach out to me there.
Awesome. Well, thank you so much, Thomas, and we'll talk to you soon.
Yeah, Happy New Year.
Yeah, Happy New Year, everyone.